Welcome. In this video, we're going to discuss flexible budgets and standard costing. This is an extension of our earlier discussion on budgeting, whereby there are two aspects to budgeting: a planning aspect, which is the preparation of budgets, and a control aspect, which is the utilization of budgets for control purposes. We utilize a budget for control purposes by comparing our actual results to our budgeted results. This often creates a potential problem, as is illustrated in this exercise right here. As you can see, our actual level of sales is distinct from our budgeted level of sales. So when we prepared our budget, that's what we would more correctly or more precisely refer to as a static budget. We based that, in this example, on 12,000 units. We had a budgeted net income of $262,000. We actually only sold 10,000 units with an actual net income of $25,000. So when we start to try to analyze this, we would compare our static budget net income to our actual net income and determine that we have a $237,000 unfavorable net income variance. So the first thing we would want to do is drill down into that number, break it out into its various different components, and that's what we've done right here. Then the second thing that we would want to do is we would want to try to get a handle on what has caused this to happen. And specifically, we're trying to answer two questions here. One is how efficient we've been, and the other is how effective we've been. Now, you'll remember, efficiency refers to the relationship between inputs and outputs. Efficiency is essentially the same thing as productivity. Effectiveness refers to how well we've accomplished our objective. It has to do with concepts of capacity. We purchase assets in order to generate output, that output being sales. So we always want to have a handle on how well we are utilizing our capacity. So while we can take this variance and break it out into these various different subcomponents, we really can't get any kind of handle on how efficient we've been. We can't get any kind of handle on how effective we've been. For example, here we have a favorable variance for variable cost, but we can't interpret that. Why? Because it's possibly favorable because we did a good job of managing those resources, but likewise it might be favorable simply because we ended up producing less units than we had budgeted to produce. So how do we address this problem? We address this problem by creating a flexible budget. Here's our static budget based on our 12,000 units. By calculating budgeted unit costs for any item that's variable in nature, we can thereby have a budget formula that will allow us to calculate a flexible budget for any level of output. In this particular case, we want to have one for 10,000 units because that was our actual level of output. Once we've done that, we can start to make some meaningful comparisons. The first thing we would want to do is calculate a flexible budget variance. That's the difference between our actual output and our budget at the same level of output. So, for example, our flexible budget, assuming 10,000 units of sales, is $100,000. Our actual sales for that same level of output was $25,000. Therefore, we have a $75,000 unfavorable variance. We would break that out. As you can see, we've got a favorable sales variance. That's a result of the fact our sales price was higher than our budgeted sales price. We've got a pretty significant unfavorable variance here related to variable costs. We'll need to drill down into that in a second. And likewise, you can see we have a rather insignificant variance related to fixed costs. So that's the first thing that we would do. We would look at our flexible budget variance. This is going to give us an insight into how efficient we've been in utilizing our resources. Then we would calculate a sales volume variance. This is going to give us insight into how effective we've been. Sales volume variances are calculated by comparing a flexible budget to a static budget. So our static budget here is based on 12,000 units, which is some measure of our capacity. 10,000, our flexible budget is based on 10,000 units, which is the actual level we operated at. So before we go any further, what these sales volume variances tell us is we're operating below capacity. And as a consequence of that $237,000 unfavorable variance, $162,000 is attributable to the fact that we're operating below capacity. We're operating a little bit above 80% capacity. So the very first thing you want to do in any one of these problems is identify what is your capacity. In this problem, it's 12,000 units. The very second thing you want to do, identify the actual level of output. In this problem, it's 10,000 units. All analysis will take place based on that actual level of output. Okay, so we're operating below capacity. That's had a significant financial impact. In terms of efficiency over here, we see it looks like we've got some kind of problem here related to variable costs, so we would want to drill down into that. If we're a manufacturing entity, then where our costs going to be? The majority of our costs are going to be in the manufacturing business process, so we need to take a closer look at that. Okay, here's what we have, what we refer to as a standard cost sheet, and this gives us our budgeted input quantities and our budgeted input prices, which allows us to calculate our standard cost per unit of output for every one of our manufacturing variables that we'd be working with. So if you haven't noticed, what we're doing now, we've kind of come full circle in this course. We started off talking about costing our products, and once again, we're talking about costing our products, only now we're working with standard costs, as opposed to what we worked with at the outset of this class, which was actual costing or sometimes normal costing. So just like we did back then, what's the first thing that we want to do? We want to get a handle on what's our costing system look like. In this particular case, we've got a pretty simple costing system. We've got two cost categories, direct material and direct labor. Those are direct costs, and we've got two cost pools, one for variable manufacturing overhead and one for fixed manufacturing overhead. Because these are indirect costs, they will have to be allocated. In order to be allocated, we have to calculate an allocation rate. In order to calculate an allocation rate, we got to answer two questions. Question number one, what's the cost allocation base? Well, in both of these cost pools, it's machine hours. Question number two, are we going to use actual costing or are we going to use normal costing? You will recall that normal costing means the use of budgeted numbers to calculate the allocation rate. Well, we're using budgeted numbers for everything now because we're doing standard costing. So let's come down here and take a look at this allocation rate. Before I go on, this little comment right here, notice this is using volume-based costing. What do I mean by that? Well, remember, volume-based costing stands in contrast to activity-based costing and has to do with what are your cost allocation bases. We're using machine hours, which is an input measure of production volume. All right, back to the calculation of our allocation rate for variable manufacturing overhead. Our standard rate is going to be 144,000 divided by 4,800 machine hours, and that's going to give us a standard or a normal rate of $30 per machine hour. So question, where did this number come from and where did this number come from? Let's start with the $144,000. Where would we get that number from? Well, we'd go back to our static budget, and what was the budgeted amount for variable manufacturing overhead? It was $144,000. Likewise, when we come to calculate our fixed manufacturing overhead rate, we're going to need to know what our budgeted fixed manufacturing overhead cost is, and we're going to pick that up from the same place, $276,000. Now, don't ever lose sight of the fact that some of these costs are variable and some of these costs are fixed. So notice that my fixed manufacturing overhead cost, irrespective of whatever level of output we're working with, is going to stay the same, whereas my budgeted variable manufacturing overhead cost is going to change as that level of output changes. The clearest way to get this straight in your head is to use a simple and extreme example. Let's assume that our budgeted level of output is 1 unit. What is my budgeted variable manufacturing overhead cost? It's going to be $12. What's my budgeted fixed manufacturing overhead cost? $276,000. Okay. Assume that my budgeted level of output is 2 units. What's my budgeted variable manufacturing overhead cost going to be? $24. What's my fixed manufacturing overhead cost going to be? $276,000. So forth and so on. Okay, so that explains where these two numbers, our numerators, are for our different cost pools in the calculation of our allocation rates. What about the denominator, the 4,800 machine hours? Well, remember, capacity in this illustration is 12,000 units of output. There are various different ways we could express that capacity. We could express it in terms of units of output, in which case it would be 12,000 units. We could express it in terms of units of input. Well, we have three different inputs we're working with here: direct materials, direct labor, and machine hours. What is capacity expressed in terms of direct material? It would be 24,000 pounds, 12,000 units times 2 pounds. What would capacity in terms of direct labor hours be? It would be 9,600 hours, 12,000 units of output times 0.80 direct labor hours per unit of output. What would it be in terms of machine hours? It would be it would be 4,800 machine hours, and that would be 12,000 units of output times 0.40 machine hours per unit of output. Okay, now that we've seen how we've calculated our allocation rates, let's take a look at what we're doing up here. We're calculating the standard cost, direct material cost to make 1 unit. Well, that's assuming 2 pounds of raw material at $30 a pound, so that's going to be a standard cost for direct material of $60. Likewise, we would do the same for direct labor, for variable manufacturing overhead, and for fixed manufacturing overhead. Now, these three items right here are all variable in nature, so they're going to behave the same. This is a fixed cost. We're actually treating it as though it is a variable cost. Remember, I previously commented that we often refer to this as the flex. When we calculate an allocation rate, we call that the flexing of a fixed cost. That's what we're doing right here when we calculate this rate. So what does this tell us? If we produce 1 unit of output using this standard costing system, we are going to cost that 1 unit of output at $111. If I've got 1 unit in my finished goods inventory, what's the value of my finished goods inventory? It's $111. If I have 2 units in finished goods, what's the value of my finished goods inventory? It's $222. If I sell 1 unit, what is the value of my cost of goods sold? It's $111. If I sell 2 units, what's the value of my cost of goods sold? It's $222. Now, there's 2 reasons why we might use a standard costing system, which is what we're looking at right now. One reason is because we want to ultimately calculate these variances and analyze them, which is the focus that we have. The other is we have no real interest in using this for a control purpose, but we just want to use a standard costing system because it makes our costing that much easier. Why? Well, anything in my system is going to be costed at $111. That's a whole lot easier than working with actual costs. And as a consequence of working with actual costs, I got to deal with cost flow assumptions, LIFO, FIFO, and all of those kinds of problems. I would add that if we were only interested in costing and not trying to squeeze out these variances, we could simplify our costing system right here by just lumping these 2 things into one cost pool because they both have the same allocation rate. So instead of having a variable manufacturing overhead rate and a fixed manufacturing overhead rate, we would simply have an overhead rate, and that rate would be $87.50 per machine hour. So in this problem, what is our cost of goods manufactured using standard costing? It's 10,000 units times $111. What's our cost of goods sold? Assuming we sold all 10,000 of those units. We had sales of 10,000 units. It would be 10,000 units times $111. Okay, once we've fully looked at what our different standards are, we need to now look at what actually happened. Well, we actually produced 10,000 units. We used 22,200 pounds of raw material. We paid $31 per pound. It actually cost us $688,200. We actually used 9,000 direct labor hours at $22 an hour for a total of $198,000. We actually used 4,500 machine hours, and we actually incurred variable manufacturing overhead costs of $130,500 and actual fixed manufacturing overhead cost of $285. So now we have our standards and we have our actuals. As always, we want to do as much work a priori as possible before we start calculating things. 2 reasons for this. One, if we kind of reason our way through what should happen, that helps us to understand what we're doing a whole lot better. And secondly, when we get around to actually calculating something, then we already have a good idea of what that should be, so that gives us some type of feedback. So, in terms of flexible budget variances for our different manufacturing inputs, direct material, direct labor, variable manufacturing overhead, fixed manufacturing overhead, we can draw a couple conclusions. Are we going to have a favorable or unfavorable flexible budget variance for direct material? Well, our actual costs are $688,200. What were our standard costs for direct material? Well, as we saw on the previous slide, our standard cost per unit was $60. We made 10,000 units, so that's $600,000. So we are going to have an unfavorable direct material variance of $88,200. What about direct labor? Our actual direct labor cost is $198,000. What was our standard direct labor cost to produce the 10,000 units we produced? Well, as you'll recall from the previous slide, our standard direct labor cost per unit of output was $16. If we made 10,000 units at $16, that's $160,000. So we're going to have an unfavorable variance of $38,000 for direct labor. If we come down here to variable manufacturing overhead, our actual cost is $130,500. What was our standard cost for variable manufacturing overhead? Well, our rate was $12 per unit. We produced 10,000 units, so that's $120. So that's going to be a flexible budget variance of $10,500. And finally, fixed manufacturing overhead. We actually incurred $285,000, and our budgeted fixed manufacturing overhead was $276,000. So we have an unfavorable flexible budget variance for fixed manufacturing overhead of $9,000. Okay, now we need to drill down into those flexible budget variances. First, I want to draw your attention to the fact that these three resources all behave in the same way. They're all variable resources. This is a fixed resource. Whenever we're talking about variable resources, we're interested in efficiency. Whenever we're talking about a fixed resource, we're interested in effectiveness, because a fixed resource represents capacity. So our flexible budget variance, for example, for direct material, which is $88,200, can be broken down into two components. One is a price component and one is a usage or an efficiency component. That's going to be true for materials, for direct labor, and for variable manufacturing overhead. Fixed manufacturing overhead we're going to have to deal with a little bit differently. When we're talking about fixed costs, we can't really talk about them in terms of efficiency. We want to talk about them in terms of effectiveness. So we're going to look at a volume variance for fixed manufacturing overhead as well as a price variance. Okay, there's a couple ways to do this. One is with formulas, the other is with a chart. My suggestion is, if this is new to you, you work with the chart, because all you got to do is set it up and then you can plug in the numbers. So to set up this chart to calculate your variances, you need to create three columns. One is actual quantity, actual price, actual quantity, standard price, standard quantity, standard price. Now notice this is all dealing with inputs. So that's the actual quantity of input, actual input price. Okay. All of this is based on the analysis of 10,000 units of output. All right, so we come over here to our first column, actual quantity of input times actual price. We actually purchased and used 22,200 pounds of direct material to make the 10,000 units that we made. We actually paid $31 per pound for a total of $688,200. To calculate a price variance, what do we need to do? We need to hold one. We've got two variables here. We need to hold one of them constant, which is going to be quantity, and allow the price to change. So here's actual price, here's standard price. So here's our product of these two numbers right here. Here's the product of these two numbers right here. The difference is my price variance of $22,200. Now think about that for a second. What's happened here? We had budgeted to spend $30 a pound. We spend $31 a pound. How many pounds did we actually use? 22,200. So that $1 times the 22,200 is our price variance. All right, over here we're going to calculate a usage variance or an efficiency variance. We've already got our middle column here, which is actual quantity times standard price. Over here we're going to have standard quantity times standard price. Now here is where students often make a mistake. They see standard quantity, they get that confused with capacity, and they put 12,000 in here. So first off, that doesn't make any sense, and the numbers should jump out at you. Secondly, this right here is standard quantity of input. How many pounds of direct material should we have used, did we budget to use to make the actual number of units that we produced? Well, we produced 10,000 units, and we should have used 2 pounds per unit, so we should have used 20,000 units. All right, so this product right here of $600,000 would be compared to that, and that will allow us to calculate our efficiency variance. Collectively, these two together sum up to our flexible budget variance for direct material. Now, before we even get to this stage right here, if we go back and look at our input numbers, we can a priori determine what's going to happen with respect to a price variance and an efficiency variance. For example, if we use 22,200 pounds to make 10,000 units, what was our actual usage per unit? It was 2.22 pounds. What was our budgeted input quantity? 2 pounds. So we know we're going to have an unfavorable usage variance. Likewise, we know we're going to have an unfavorable price variance because our budgeted input cost was $30 and our actual input cost was $31. We don't know what those quantities are actually going to be, but we do know whether they're going to be favorable or unfavorable. Likewise, if we look here at direct labor, what was our standard input quantity of direct labor? 0.8 hours. What was our actual direct labor usage to make 1 unit of output? It was 0.9 hours. We used 9,000 hours to make 10,000 units. And what was our budgeted direct labor cost? It was $20 per direct labor hour. And what was our actual direct labor cost? $22. So once again, we know we're going to have an unfavorable price or wage variance, and we're going to have an unfavorable usage variance. Okay, so when we come here to direct labor, plug in our numbers, 9,000 direct labor hours at $22. That's our actual direct labor cost. Actual quantity, standard price. We're holding quantity constant, allowing price to change. We're squeezing out our price variance, which is 18,000 unfavorable. Over here, actual quantity of input for the standard quantity of input for the actual level of output would be 8,000 units. So that's $160,000, and we squeeze out our unfavorable $20,000 efficiency variance. Collectively, these add up to our $38,000 unfavorable flexible budget variance. As I said just a moment ago, we already determined that these amounts were going to be unfavorable. We just didn't know how much. Okay, exact same logic when we come over here and do variable manufacturing costs. Even though this is an indirect cost, behaviorally it's the same as the other two resources, direct material and direct labor, so we would analyze it in the same way. In other words, my flexible budget variance is going to be a result of how good a job I did in controlling the input price I paid and how good a job I did in terms of being productive or efficient in the utilization of that resource. All right, my actual quantity of input times actual price, the product of that is my actual cost, which was $130,000. Actual quantity of input was 4,500 machine hours times standard price. Gives me this product right here. I squeeze out that I have a positive price variance of $4,500. Standard quantity of input for the actual level of output, I should have used 4,000 machine hours to make the 10,000 units I actually made. That was what I would have budgeted. And so that's 120,000, allows me to squeeze out my $15,000 unfavorable efficiency variance. That nets together to 10,500. So these three items, direct material, direct labor, and variable manufacturing overhead, we're going to analyze in exactly the same way. Okay, fixed manufacturing overhead. Here we have to analyze this differently. Why? Because this is a fixed cost. Well, what does that matter? If we're talking about a fixed cost, we're talking about capacity. When we're talking about capacity, the question is, how effectively have we utilized the capacity that we have paid for? We have capacity to produce 12,000 units. The budget, the cost of that capacity was $276,000. So all we need to do here in our chart is switch out the middle column and just put in the budgeted amount. Notice that whether it's the static budget or the flexible budget, it's not going to make any difference because it's a fixed cost. That cost doesn't change amongst those different levels of output. It's $276,000. Okay, so let's start with this part here. We're going to compare what we actually paid to what we budgeted. And we're going to call that a flexible budget variance, or more specifically, a price variance. Over here, in this column right here, we're going to analyze it the same way we have all along. The standard quantity of input per the actual level of output times our rate, standard rate, gives me 230,000. This is going to reflect how much my production is, how much of that capacity I've utilized. And the difference between that and my budgeted amount is going to be my production volume variance. Now, the easiest way to understand this is, let's assume that you produced 0 units. What would these numbers be? Well, that wouldn't be any different because that's a fixed cost. That wouldn't be any different. But what would this be? This would be 0. And so what would we have had here? We would have had a $276,000 production volume variance, which would reflect the fact that we operated at 0% capacity. Likewise, you could go back to the previous ones and ask the same kind of question. That's a useful thing to do to make sure you understand how this column over here is going to be driven by, well, this column over here and this column here are going to be driven by our actual level of production. Okay, so here we have a summary. We have a stat of what we've done. Static budget variance. Actual results versus our static budget. Can't do much with that. We've got to create a flexible budget variance, which allows us then to kind of go down the path of flexible budget analysis, which gives us insight into how efficient we've been, and sales volume variances, which gives us insight into how effective we've been. So we can take our flexible budget variance, we could do it for our sales. That's the type of thing we do over in marketing. We're focusing on costs in here, so if we looked at our direct material variance, that can be broken down into a spending and an efficiency variance. Direct labor, same thing, spending, efficiency variance. Variable manufacturing overhead, same thing, spending, efficiency variance. These terms might be a little bit different. For direct material, it might be spending. For direct labor, it might be wage variance. But they're referring to the cost. This is how well we've controlled the input price, and this is how well this is how productively we've utilized the resource. Then we get over here to our fixed manufacturing overhead cost. Notice that we have no efficiency variance that we calculate, because efficiency is kind of a meaningless concept when we're talking about fixed costs. Doesn't matter how efficient we are. What matters is how effective we are. So we definitely want to calculate a production volume variance. And finally, over here we have the journal entries. So when we purchase our direct material, that will go into our direct material. Everything goes into inventory at standard. So when we purchase our direct material, that's going to go actual quantity at standard price. So that was $666,000. What did we actually pay for that? Actual quantity at actual price. We actually paid $688,200. That's where we're going to squeeze out that unfavorable price variance of $22,200. When we actually put that direct material into production, it's going to go into our work in process inventory at standard. It's already at standard price. It's now going to go in at standard quantity, so it goes in at $600,000. So the production cost for direct material for the $10,000 for the 10,000 units we produced is $600,000. At this point, we squeeze out our usage variance. So now we have both our price variance and our usage variance with respect to direct material. With respect to labor, here's our actual labor cost. This is the amount of labor cost that's going to be charged to production because we're using the standard costing system. And in the process, we're going to squeeze out a wage and an efficiency variance. We're going to do the same thing over here for variable manufacturing overhead and for fixed manufacturing overhead. So when we were done, if we looked at a T account for work in process for the 10,000 units that we produced, what would we have? We would have $600,000 of direct material cost, $160,000 of direct labor cost, $120,000 of variable manufacturing overhead cost, and $230,000 of fixed manufacturing overhead cost for a total of $1,110,000. And then when we transferred that cost of goods manufactured out of work in process into finished goods, our finished goods inventory, those 10,000 units are now sitting in finished goods, they would be valued at $1,110,000. And then when we sold those 10,000 units, our cost of goods sold would be $1,110,000. And then, of course, what do we have to do with all these variances? Just like we saw back in the beginning of this course when we talked about job order costing, what do we do with variances? We close them out to cost of goods sold. So all of these variances would be closed out to cost of goods sold. Okay, this is what our journal entries would be if we were using standard costing for management control purposes. In other words, we were interested in looking at these variances. What would happen if we were not interested in using a standard costing system for management control purpose, but we simply were wanting to do it to simplify our costing system? Our entries over here would be more compressed. Okay, direct materials, when we acquired our direct materials, would be the same thing. We'd squeeze out our price variance, we'd squeeze out our usage variance at the time that we utilized direct material. We wouldn't bother to break the flexible budget variance for direct labor out into the two different components because we're not interested in looking at those variances. Likewise, same thing would happen here with variable manufacturing overhead and fixed manufacturing overhead. This is missing I think it's $55,000 underallocated fixed manufacturing. Okay, that's a comprehensive example of standard costing, flexible budgets, variance analysis. That's it.